Hey everybody, Preston Brent here with our weekly roundup for the Trader User Group. This is for the trading week ending April 7th, 2017. Before I jump into the charts, just a real quick note, this is going to be a holiday shortened week. Thursday in the afternoon, I believe we get the bond markets are closing early here in the U.S. And then on Friday, all markets are closed here in the U.S. In fact, mostly around the world. It's Good Friday, so we'll see markets closed in Canada and most of Europe, Hong Kong. We're getting some of the bond markets. Some of the other markets, I guess, will also be closed on Thursday as well. Now, this Monday, markets will be closed in Israel for Passover. So it's going to be a holiday shortened week. We can expect perhaps a little bit more volatility, a little bit lower volume as we go into a long holiday weekend. Now, looking at the chart here, this is the daily chart of the S&P 500 E-mini futures. Now, folks, you got to understand, the market is a discounting mechanism. In other words, today's prices really are reflecting tomorrow's expectations or what the market expects for tomorrow. Now, most rat brain traders, generally, you get your news from today's headline number. So generally, your market timing regarding price is probably and most likely wrong. You're always buying high and selling low versus the age-old axiom of buy low, sell high, which, by the way, it's inherently very hard to do. The human trait and the general tendency, if you throw fear and greed in there in the human emotion, is to buy high and sell low because of fear or greed, depending on which side of the equation you're on. That's why a lot of rat brain traders have difficulty, and you generally get your rat brains generally get their general business news from the National Enquirer, the Rat Brain Business Journal of the day, or the USA Today, because they have such pretty colors and color print and paint by number stuff. But anyway, I digress. The market is a discounting mechanism. Now, we saw in Q1 a lot of records broken. The first record was in NASDAQ. I mean, heck, the NASDAQ had more record closes by the end of Q1 of 2017 than any other quarter since 1999. That's right before the dot-com bubble. All right, and we're seeing the stock market right now. It's not fairly valued. It's a little bit richer, not like the dot-com bubble era, but it's still it's harder and harder to find, for those of you fundamentalists out there, really undervalued stocks. Now, if you measure the stock market as a percent of GDP right now in the U.S., the market is about 207% according to Barron's, and I saw that. And by the way, going into the credit bubble in 2007, 2008, it was about 181%, and even the dot-com bubble was 202%. So we are, from a percent of GDP, because the GDP is very low right now in the U.S., the market is very richly valued. So what does that mean for current price action? Not a lot, because price action is driven, as I said before, by fear and greed and sentiment. And if we look at the chart here, you can see that there are, we've got this very nice symmetrical triangle setting up like this, right? And, you can have a possible upside breakout or a downside breakout. Generally with a symmetrical triangle, technically speaking, depending on how you enter it at the mouth of the triangle is, what governs how you break out of it. Now, this is not an ideal symmetrical triangle, right? Because really the first touch we got was down up here towards the right side of this triangle here. But the odds, if you're just following pure technical analysis, because we entered the triangle from the lower left coming up, that suggests an upside breakout. I've been telling our members that we could probably expect a possible downside breakout. I've been looking for a dip in the markets anywhere from 3 to about 7% over the next 30 to 60 days. All right, I think it would be very healthy for the market. Now, we may get more, we may get less, or heck, we may not get anything, because it doesn't really matter what I want or what I'm looking for, but I'm just saying what the charts are telling me right now. And if we look at this market here, you can see that we've recently, going all the way back to the middle of March, we've got a classic trend starting to develop to the downside, right? I can point on here the definition of a trend is lower highs and lower lows, or higher highs, higher lows. And you can see here that's the first touch, that's the second touch of a trend. You need at least two to form a trend. Obviously the first one doesn't count because that's the origination point. And then you got one here and you got two here, right? So we've got a setup here, and you can see in each of these instances here on this trajectory from here to here and down here, but we've touched perfectly the upside of this down-sloping trend line, right? And then down below, we've always managed to close above the upsloping trend line. So what that does is it generates a tighter and tighter pattern until you have a clear break. And then when you have a clear break, what I'm going to be looking for is the prior pivot point taken out, okay? Now, again, you always trade based on the time frame that you're looking at. In this case, we're looking at a daily chart. So you can come in and find these patterns all the way across from tick charts to monthly charts. But generally, most traders will stick with a daily and then break it down into intraday to get a kind of a general direction or a bias for the next 7 to 10 trading days or 2 weeks out. But you can see here where we're looking here. Now, I tend to favor the downside, although technically you can see that wide, fast move up, and then boom, we enter this sideways pattern. This is a way also for the market essentially to consolidate its gains, right? I mean, one way for a market to consolidate is it moves up, it moves back a little bit, and then it moves up, and it moves back a little bit, and it moves back, and then we just make a series of higher highs, higher lows, and then we move up, right? So this little move right here, you know, could be exactly what we're going through right here. Time's always going to tell. But when we break this triangle, and you can also see this red line is the 50 EMA, which we're touching. We've kissed nicely for a couple of days. We're going to come to an injection point or an inflection point, and we're going to break out one way or the other. If we break to the upside, what I'm going to be watching for is basically a break above 23.75. If we break that, the two prior pivot highs, 23.75 and 23.88, roughly, these are the numbers. And I just don't see I don't see anything getting us there except for one thing. After this holiday week, we end the week, by the way, on Thursday, we have bank earnings starting to hit the wire. Now, banks have been punished dramatically recently with interest rates going down instead of up on the prospects of higher interest rates by the Fed. We get JP Morgan, we get Citi. They kick off the big bank earnings, the global banks. They come out on Thursday. We also get PNC Financial. We get Wells Fargo. So we get a dearth, or that would be a wealth, of banking earnings coming out before the long holiday weekend. And banks in the sector, the banking sector, is down. Now, we rode, for our members, we had great plays in the banking sector post-Trump election, and then we got out as the market started to roll over. It just didn't seem right. We took our profits and ran. But you can see here that going into Thursday, we're going to get a key tell. So what would break this thing out and start to move it higher like this and get punched through all of these pivot points and then take out our all-time highs in E-minis at 2401? These are the E-mini futures, right? Would be starting to get wind that earnings are coming in above expectations. That will do it. Outside of that, the markets are on a wait and see report. Remember what I said. Markets are a discounting mechanism, and today's prices essentially reflect tomorrow's expectations, right? So right now, what's really propping up this market is the fiscal policies, or the potential fiscal policies of the Trump administration. Lower taxes, less regulation, repatriation of money for corporates overseas, bringing it back home, getting all these things done. Big infrastructure, generate more money, more jobs. Those are huge fiscal policies. So the markets post-Trump election have moved up about as far as they're going to go on fiscal potential expectations of these changes, right? Until we start to see things out of Congress where these things are actually getting done, because right now politicians do what politicians do. They get together, they fail, then they go on a 2 or 3 week vacation. Yeah, that's what they do. Republican, Democrat, I don't care. They're all worthless to me. I just follow what what the markets are doing, and price action is going to tell you. So right now, I think the price action's pretty much reached its limit based on a fiscal move. Now, the only thing, again, as I said, that'll get it up over here is if you have good corporate earnings, very strong, then I think you'll see us, take out these areas here. So that's coming up very soon. Okay. The other thing that moves the market is monetary policies. Now, monetary comes from the feds or the central banks, right? And the central banks, we've seen the feds come out, and the feds came out and they released their FOMC meeting minutes, and they basically said that they're going to start reducing their $4.5 trillion balance sheet. Now, on that announcement, bonds sold off, okay? And the U.S. dollar got stronger, because there's a couple of ways the feds can raise interest rates. One way is they can obviously go into the open market and just raise interest rates, and then boom, the markets are reflecting that, and then you got higher interest rates. And by the way, the markets have already now discounted 2 rate hikes for the year. Some Fed governors are already coming out saying there should be 3. But now, once they start reducing the balance sheet, they do that because remember, they bought $4.5 trillion worth of bonds, or some crazy number like that. It's over $4 trillion. When those bonds start coming due, I think in this year alone, we got about $450 billion in bonds coming due. Now, what do the feds do? Do they roll those over and just keep the bonds going, or do they take them off the table and have other buyers step in and buy them, right? If they take them off, it's going to start racking up higher interest rates. So there's going to be, there may not be a need to raise the rates if they start reducing the balance sheet. And keep in mind, we've never been at this point before. In fact, we've never had 4.5 trillion or even a couple of trillion on the balance sheets to take off. So the markets is a big unknown. The known is we've got to get it down. The unknown is how the market's going to react to that. Now, I'm still on record as saying in the next 12 months, maybe 12 and a half, but 12 months. And I haven't been saying 12 months for 3 years now. I've only been saying it for about 6 months. And I've said about a year and a half. We're going to have a 25 to 40% pullback. And I have a feeling something's going to go pop. And I don't know if it's going to be generated from China. It's going to be generated from the Middle East in a geopolitical standpoint, or it's going to be generated by the U.S. Feds. Who knows? Who cares? But we're going to be watching this. And our members, we made some of the most money we've made in our group in 08 and 09 in the debacle that we call the credit bubble. And there's going to be some great opportunities coming up. So anyway, this is the chart. This is how I'm looking at it on the S&P 500. You can see the all-time high. You can see the open price. So we're still well away from the 2017 open. However, if we look at the Russell, which is small cap and mid cap, look at this, guys. The Russell just about, and I'm going to just blow this up so you can really see it, right? Right here. Well, let me just move this chart around so you can actually see this a little bit more. And let's take it down just a little bit like this. There you go. Now, you can see here on the Russell, that's where it closed right there. We're basically sitting on the 2017 open price. So we are in the green, but I mean by what? A point. The all-time high in the Russell was right here, made in late February, 1415.90, and now we're sitting here just on the 2017 open. We were actually in the red even for Friday, before it kind of made a last-ditch effort to regain 1360.30. Okay, so the Russell is clearly the underperformer, and again, we are making a series of lower highs and lower lows as we come down. And you can see over here where buyers versus sellers are really fighting it out. This is volume over price. You can see there's a huge amount of volume right there and another huge amount of volume right there. So that's going to serve as our R1 point or resistance point, because there's a lot of, in this case, sellers won out because it drove the price down. So there's going to be a huge amount of resistance up here. Right here, buyers and sellers are really fighting really hard, and neither is won. So we're going to see which way this goes in this holiday shortened week. And with the geopolitical risk now back on the table with the missiles and Russia coming into the into the Mediterranean Sea, it's going to be real interesting to see if people want to hold risk over the weekend, the long holiday weekend. And there's going to be a lot of factors that come into play, because the other thing that's going to be interesting is next Tuesday. I promise you, you're going to see it on TV. Secretary of State Tillerson is going to be meeting in Moscow with the Russian Foreign Minister Sergei Lavrov. I would love to be a fly on the wall in that meeting. Can you pass the borscht soup? And by the way, we're launching another round of missiles. It's going to be real interesting. But net, markets are in a very downward move. But remember what I said, there were a lot of records set in 2017. The other record that was set, even with this downward move, is volatility. What record was set in volatility? Now, this is truly amazing, guys. I want you to understand this. This first quarter of 2017, the VIX ranged from in the mid-teen, low tens, 10 point, down around 10 point. You can see the VIX low here, right? Let me just move this over. You can see it's about 10.30, right? So it ranged from about 10.3 to the low 13s, right? Where it closed. And I'm talking about where it closed, not just the spike. And the average for the first quarter was 11.69. That's the lowest quarterly average to kick off the year since the VIX was created in about 1990. That's amazing. I mean, we're talking low volatility. And it's the second lowest of all time for any quarter going back to 2006, right? Q4. So it's just really a Q4 in 2006. So it's really extremely low. But here's even more amazing. The SPX, the historical volatility, mean realized volatility, what's already occurred. For Q1, you guys ready for this? The historical volatility for the SPX came in at 6.69%. I mean, that's at the 4th percentile. That, folks, is like on the floor. That's the lowest for historical before they invented the VIX, but just the actual movement going back to 1929, according to Barron's. That is very, very low. I mean, 4th percentile, and it's the lowest quarter going back to 1965. So needless to say, vol is extremely low right now, right? I don't think I need to tell you guys anymore. Now you can see here I've got zone 1. It's green. I've got zone 2, which is kind of yellow. Zone 3, it looks like it's purple. Zone 4 is red, and then black, which is the black swan event. You can see we had a 2015 high with the Chinese yuan devaluation over 2%. It drove the VIX up to 53.29 from the mid-12s. In less than 4 days, it was the highest percentage gain of the VIX ever, right? So don't believe that the VIX can't go from down here to what I would consider a black swan event in a matter of days, less than a week. It'll and if you're selling strangles, you'll get killed. You'll get killed. You'll get margin calls before you even have a chance to heat up your coffee, or even make your coffee. But volatility can stay lower a lot longer than you can stay long volatility. Anything in the green zone here is basically low vol, and you can see since the November election right there, that was leading up to the Trump election. Everybody thought Trump would be a thump, and he turned out to be the best thing since sliced bread for the markets, because as soon as he was elected, boom, volatility goes down, and we haven't gone anywhere since, right? Now, what's going to be the fuel to blast this thing back up into zone 2 and possibly even to zone 3? It could be anything. There's geopolitical events like wars, missiles flying, North Korean threats. There's monetary or fiscal events like China and others and what they do with their economy. There are a number of things. I don't think, and because we've been low, there's a lot of fear out in the marketplace, but we can stay low for a very long period of time. You can see here, we were down in the green back here for about 4 or 5 months, right? So we can basically stay low for a long period of time. But then when you get those spikes, they're very hard to plan for, all right? and then boom, away they go, and you're just going to be caught. So you've got to have hedges in your portfolio. All of the trades that we do for our members in our secret trader portfolio are hedged. And if you're not a member of our group, I highly encourage you to come in and check us out. We get folks coming in all the time. So anyway, that's where we're sitting with volatility. All those records broken, really amazing. The other thing that we saw last week is the Feds coming out and talking about doing something with their balance sheet. And the minute they did that, the bonds just, they fell off. Now, you can see here on this daily chart of bonds, let's just kind of elongate it a little bit. You can see here that bonds had a huge spike to the upside, or just a huge spike. And that spike was on, believe it or not, and let's come into a shorter time frame, because I was watching the bond market because I'm in and out of bonds. You can see this spike here was right at the jobs numbers Friday morning, right? And what was really interesting, as you guys know, for our members, we were in our chat room trading and putting on trades in gold and others when the missiles were flying. I mean, we were in the markets trading. And you can see what I found fascinating, and I think I saw another guy talk about it as well, and I caught the same thing. Bonds moved up on missiles flying, but it was kind of viewed as a one-time thing. And as you can see here, because money goes into bonds, when bonds go higher, right, then interest rates basically go lower. It's a fear gauge, right? It's a fear gauge. So the missiles were flying, bonds went here, but we got a bad jobs number, and look at bonds. It just went all the way up here over 153. And then there were some merrily happy sellers that just said, I'm shorting that sucker. There are a ton of shorts sitting up here. So bonds are going to have a hell of a time trying to break this area because there's just a lot of shorts. Now, they can be broken, but it ain't going to be easy. It's going to take a bear market or a big fear to get that going. You know, war with North Korea would get it going, or fisticuffs with North Korea or Russia will get it going. Right, so you can see here, and then the market's just basically, or the bond market gave it back up again, right? So, and with the Feds moving to cut their balance sheet, also drove bonds. I mean, bonds spiked, and then you could see the U.S. dollar when that happened. The U.S. dollar is stronger, right? Because the Feds are going to be in a pickle. Look at the U.S. dollar on this 15-minute chart. Let's take it back out to a daily. We had a key breakout on the dollar, right? We broke above 100, and now you can see this breakout here. The next key level to break out is right in this area, just above a Fibonacci 102 area. And that's where we're headed, guys. We took back the 50 EMA. The 200 EMA held us up. Now, I still believe longer term, there is no divergence here. So I do believe longer term, dollar's going to run up and it's going to start to come back down again. And then the only thing that's going to move that back up again is how the Feds handle the U.S. balance sheet. If they F it up, then you're going to see the U.S. dollar really move higher until such time that Europe and Super Mario comes to the rescue and starts taking stimulus off the table. And as you guys know, just last week he came out and said we're still going to be actively maintaining our stimulus. So that tended to weaken the euro in relation to the dollar. Now, the other thing that we were playing in the missiles launching was gold. Gold had a great move up and then immediately sold off. If we come into the 15-minute chart, you can see here with gold, missiles launched, boom, here we go, right? I mean, it just took off. And then we came in with a bad jobs number. And then again, bonds even made a higher high from the missiles launched, unlike bonds. And then things just settled in, and then away we went right here. So that tells me that there's still more shorts in gold, or buyers that want to drive the price of gold down than up. Although I still believe gold is going to end the year higher than where it started. I'm on record as saying gold's going to finish stronger in 2017. Now, if we get that pullback I'm looking for in the next 12 months, 12, 16 months, something like that, then you're going to see gold, you know, broach 1,400. But right now it's kind of in a wider, let's say a choppier range here. And, you know, well, actually, let me just redraw that box. We had a breakout, but then it was a failed breakout because I could just come all the way back over to here, right? And just kind of mirror this thing right here. And you could see, and I could probably include that over there on the left-hand side as well. We had a failed breakout right in that area right here on that right there, that failed breakout. Let me just put it back on the screen here. So you can see right there with that failed breakout. Now we were steady, starting with mid-December in gold. We were playing gold to the upside, and then when we broke the trend line, and then we also broke the 50 EMA, we caught ourselves, which is kind of what I thought we'd do, right around the 1200 level. It's a psychological barrier, and gold historically has tended to hold up at the 1200 level. But I think we're still in here until we break this out and then really broach 1300 with volume and conviction. Then it's mostly a sideways to choppy range for gold. Energy, oil also moved up strong when missiles were flying, right? If we look at the chart, and we were playing oil, missiles were flying, right? But this was more of a one-time event right there. Missiles started flying, oil goes up. And then it basically gives up all the gains down here, and now we're kind of right in the middle here of the range. I think longer term there's going to be more downward pressure on oil. I don't see a big future for oil back over 60. You can look at this daily. You can see we're still below the 2017 open. I think as oil gets a little bit higher, now I'm on record as saying oil could probably come up into this range right here, but I'm going to be happy sellers of oil premium in the futures market, or even in the options market on futures, or shorting oil, because I just don't see it maintaining something up here. OPEC's already talking about another production cut, but you know, the shale frackers here in the U.S. love this stuff. So I could go into a lot of detail on this, but I'm not. We've had 5 trades in a row in our secret trader that have been successful with oil, and that I think is going to continue. Now, one interesting take here. Look at oil. It's moved up, but we're nowhere near the highs here. But look at gasoline. We're in the seasonal strong period of gasoline. We actually made a 2017 high on Friday in gas. There is no divergences here. Gas is stronger. All of the inventory reports we're seeing higher oil inventory but lower gasoline. What does that mean for oil? That means that as gasoline draws down the distillates and the supplies, you're going to see a further strong demand for oil. So it's going to be upstream, or downstream rather. So that's why I do believe near-term oil is going to have a little bit of a bullishness to it, but it's just not going to be as strong. Remember, as we go into the beginning of summer months, oil is going to tend to pick up. Gasoline is going to tend to fall off. And the other one that I think is going to fall off a little bit is nat gas. Nat gas has had a huge run starting in February, going through the winter months. But now I think you're going to see this kind of find some strong resistance here. So I think there's going to be some opportunities there. Now in the ag market, in the meat market, in the soft market, we got some activity going on. In the sauce particularly, we've had some great trades. And we're going to be looking at some other things as well. We got some things on our watch list. We've got some equities that we're playing. There's some others that are lining up. So all in all, it's going to be a good opportunity here going into April. I think the month of April, I think Q2 is going to be a little bit different than Q1 from a volatility perspective. There's going to be some potential trades out there for us. If you're not a member, check us out. We put some offers in here on this email if you want to come on in and have fun with us. Otherwise, everybody have a great weekend. And members, I will see you this Sunday night for our weekly market watch at 8 p.m. New York City time. Have a great, enjoyable weekend, folks. Ciao, everyone.